Hi everyone, this is Michael Kramer of Ma Capital. Today is Tuesday, January 14th, and it's around 4 p.m. New York time. Tomorrow, obviously, will be a big day here in the U.S. We have the all-important CPI report coming at 8:30 a.m. Eastern. We're looking for a 0.4% increase month over month, up from 0.3. Core is expected to rise by 0.3%, in line with last month's reading of 0.3%. Year over year, we're looking for 2.9%, up from 2.7%. And for ex-food and energy, we're looking for 3.3% year over year, in line with last month's reading. So overall, this is looking like this could be a potentially hottish CPI report for the markets. And a lot of where rates and the dollar go from here are going to be largely dependent upon how this report comes in. Then later in the week, we're going to be getting retail sales. We're looking for an increase of 0.6%, down from 0.7. Control group, we're looking for 0.4, in line with last month. And then on the 16th, we'll also be getting import-export prices and initial jobless claims. These are obviously been a major focus of the market, 210,000 versus 201,000 last week. And then on Friday, we'll be getting housing starts and building permits. So clearly the CPI report is going to be the big one for this week, followed by the retail sales number. But again, the CPI report is going to have a lot of say in terms of where the markets move from here. And at least when we look at the euro has, again, been very weak, although to this point we've been able to hold our support level around this 102 region. Last week when we were talking, the euro had advanced to around 103.5. And obviously now we're trading back below that here again. We're looking at our 10-day exponential moving average, which again has been working really well for us now for some time. We can see that we've gotten back near to that exponential moving average, but we haven't been able to surpass it. And that was essentially what we saw last week as well. So I would continue to use the 10-day exponential moving average as a resistance level. Clearly, if we can break above it and hold that move, then there's room to potentially go back to this trend line in this 104 to 104.5 region. But again, this area here at 102 is really a big level, because if that level should break, you can see that this region here isn't going to offer much support, and that means that we could move back to parity pretty quickly should this 102 area break. The RSI is just moving sideways at this point, not really giving us any sense of momentum. We could really see the euro weaken some without triggering an oversold condition, because we're trading right now with an RSI around 41, and you can see the Bollinger Band is lower around 102. So there would be room for it to fall to potentially, even though we've seen the euro fall quite a bit, we can't really say that it's oversold at this point. We will be getting UK inflation data on the 15th. We're looking for CPI to come in at 0.4%, up from last month's reading. Core headline CPI expected to remain even at 2.6%, and core year over year expected to fall to 3.4% from 3.5%, while services is expected to decline below 5% to 4.8%. So clearly we're seeing that, even though we're seeing rates rising rather significantly in the UK, we've seen the pound continue to weaken. And this really probably has a lot to do with the fact that there's worries about, high inflation rates and an economic growth picture that is probably weakening. And this kind of has a stagflationary look to it with the falling pound despite rising rates. And this 122 region obviously is a major level of support, as we've talked about in the past, and that would mean that a break would set us up back to around 118.5 to 119. Here's our 10-day exponential moving average. So really there's a lot of room to rise there before we hit resistance. And even from a Bollinger Band perspective, plenty of room to get back towards 124.5 to 125. But the momentum indicators just aren't there, and we continue to see the gilt market moving higher. In fact, the British 10-year today moved up to 490, and we're seeing the British 30-year moving up to 546, and it looks like from a technical perspective it could move back towards 558 or so, which would take it back to levels not seen since August of 98. But I mean, clearly from a technical sense, it looks like an ascending triangle that broke out, which would suggest higher rates, and that's probably not going to help the pound versus the dollar, at least, especially if this is more of a stagflationary worry that seems to be developing. When we swing over to the yen, the yen's been moving sideways now for a couple of days. It looks like we may be forming some sort of bull flag pattern. This would actually suggest that the yen moves even higher. If we do an extension pattern, it suggests maybe the yen moves all the way up to 164.35. When you look at the yen, it's certainly not an overbought position. You could easily see the yen move back up towards this 160 level and only touch the upper part of the band. The RSI is only around 63, so right now we're kind of hovering right around the upper end of this flag, and it's not going to take much to get a breakout here and to see a move towards this 160 area, and I think there's potential to go even much higher than that. When we swing over to copper, copper's really started to move. Copper, we've been talking about this resistance level at 430. It looks like copper finally managed to break out and move above. It looks like there's still room for copper to move up. It looks like potentially the next major level of resistance here would come around 450 from a resistance standpoint. Even from a Bollinger Band standpoint, while we're touching the upper band, like I said, we're not overbought on the RSI, and that would suggest that copper prices probably could continue to rise, and I would think we could probably get back to this 450 area. Obviously, if we were to dip back below 430, it sets up a return to 415, but right now the momentum just doesn't seem to be pointing that way. When we look at oil, it looks like it's broken out of a major downtrend as well. It's had a lot of brushes with this $66 to $70 level. That seems to have held now, and it looks like oil's trying to break a major downtrend that's been in place now since October of 23. And this could potentially be a very big breakout if oil's able to get itself going. It looks like it's right now maybe trying to consolidate a little bit because we're above the upper Bollinger Band and we're above the RSI on the 70 level, and this would suggest maybe we see some sideways price action for oil prices, maybe to consolidate a little bit. But if we do see a sideways consolidation, it probably sets up the next move up. If we were to see a pullback, I would probably look for a pullback back to this 10-day exponential moving average around 75 or so. But really the big story is this break of the trend line, which I think is a very, very important signal that oil prices want to go higher, especially after a bunch of attempts to break this 66 level, and it just didn't break. When we look at the DAX has really just been moving more sideways than anything since the middle of December. At least right now, we've been going back and forth between the 10-day exponential moving average. The Bollinger Bands really aren't much of a factor here, and the RSI is at a middle ground 57. It looks like at this point, though, momentum is starting to fade a little bit with the RSIs trending lower. You are also seeing a potential here for a double top pattern. We're going to want to watch to see if we can get above this area at 20,450. If that happens, it certainly sets up a potential move even higher. Again, the DAX just seems to be moving on multiple expansion at this point. But if for some reason the DAX is unable to surpass this 20,450, I would look for a return back to 19,810. If we break this level, it sets up a potential double top, and then we could be looking at something much more severe to the downside, potentially back to this 19,160 area if that neckline breaks at 19,800. The FTSE just continues to go in no man's land. We continue to also know that the FTSE trades relatively tightly with copper over time, at least in terms of trends and directions. So at this point, we've seen the FTSE retrace to this 8180 area. But if copper is going to continue to surge, then my feeling would be that you'd probably expect the FTSE to begin to rise again and potentially move back to this 8354 region. Likewise, if we were to see support break at 8200, let's say tomorrow following the inflation data, I would look for 80,000. I would look for 8,050. That's just because that's been the movement, right? We've just been going back and forth basically between 8,050 and 8,200 and then 8,350. And that just seems to be what we've been doing now since, essentially May of 2024. So until we see a meaningful change in that pattern, it seems like this is the destiny of where the FTSE is going to go. And if you were to take a guess, I guess, looking at copper prices moving up, then I would think that the FTSE moves back up to this 8,350 area. When we look at the NASDAQ, right now we're still managing to find some support at 20,650. RSI is clearly trending lower, but it's only at 41 or so that's not really a big deal. We are kind of at the lower end of the Bollinger Band. Our 10-day exponential moving average lives up here around 21,000. What this tells us is that probably we're looking at a NASDAQ that's looking for some sense of direction. Although the trend is clearly lower, we haven't really been able to break support. And so until you break support, you got to be careful because the market can obviously very quickly rebound and retrace to this trend line. Clearly, if you were to get a weaker than expected CPI report, that would obviously be a very big positive for equity prices, and you'd probably see them rally significantly with, I would think, the major level of resistance coming probably first around 21,180, then probably 21,373, with resistance then at 21,600. So right now, until this level breaks at 20,675 or so, I think you have to be very mindful of the upside risk to this market. If you got a hotter than expected CPI report or a CPI report roughly in line and that sent rates higher and removed odds of rate cuts, then I would look for a break of this, and then I would start looking for 20,270. On the S&P, it certainly looks like we have a head and shoulders pattern here. It looks like today we came back up and tested the neckline, and that failed. But again, with a CPI report tomorrow, it makes it really tough to be overly bearish, because all it's going to take is a weaker than expected print to see the S&P rally and probably blow right through 5930 and probably move right back up to 6,000. Likewise, again, this is a big level here, 57.85 breaks, you're talking about 56.90. Clearly momentum favors the downside at this point, but you have the risk of a CPI report tomorrow, which is going to have a big influence on where equity prices go. And then, of course, you have the Dow. The Dow actually broke through the lower bound of this triangle we were talking about. It fell right to 41,890. That's where it bounced. This was the level of support we identified last week. Right now, we're right back to this 10-day exponential moving average. I would think if you got a favorable CPI report to the equity markets, you could see it return to 42,800, maybe even this 43,000 level. Clearly, if 41,950 breaks, you're talking about moving significantly lower, probably into this 40,600 area. But again, a lot of where this is going to go tomorrow is going to be based on how the CPI report turns out, not just here in the U.S., but also in the U.K., obviously, for the pound and the FTSE. So anyway, that's all we have for today. Until next time, have a great week.